Netflix is an amazing business. Meta has been soaring this year. Amazon is moving businesses to the cloud. Each of these businesses has excelled. If you want to buy one share of each of these businesses, however, you will need to invest over $1,100. Imagine owning one business, however, that generates revenue the same way as these three amazing businesses, but for only $170 for a share. Not only that, have incredible capital appreciation and dividend growth prospects for years to come. This business I'm referring to is Alphabet, commonly known as Google. Welcome to the Quality Investor. Google, ticker GOOGL, just had a masterpiece of earnings last week. The company put to rest many worries investors had about the cloud business, as well as the strength of advertising and search. The CEO, Sundar Pichai, showed that he is committed to keeping bloated costs down. He has eliminated unnecessary headcount and is controlling TAC, or traffic acquisition costs, which adds to the gross margin. And despite a few public mishaps around AI, Google reaffirmed its investment to be a leader in AI. Today, I want to evaluate Google as an investment. I will use these earnings as a springboard into the core operations of Google. We will review their economic moat and assess their long-term potential. We will look at their competitors and potential risks facing the business. And finally, we'll assess Google's intrinsic value and see if it is a stock to buy now. Before we dive in, however, remember to hit that like button below and remember to subscribe to the channel so you can stay up to date on all the quality businesses in the market. I have yet to do a video on Google, and I've had some ideas floating around in my head for a while, but this earnings demonstrated that when Google focuses on their core business, they are a juggernaut for investors. Google is now my third largest holding, and after earnings, I did add a few more shares, so you can get a hint of where this video is going. I view this business Alphabet as a collection of separate but connected companies, and Alphabet is the parent that corrals them all together. At the outset of this video, I mentioned Netflix, Meta or Facebook, and Amazon, or specifically AWS, Amazon Web Services. I believe Alphabet's three core businesses are akin to each of these. Alphabet, of course, does have other segments, but it's these three core businesses that really drive their growth. Google, as many of you know, owns YouTube, a purchase Google made in 2006 for $1.65 billion. YouTube is in many ways similar to Netflix, but it's also distinct. I actually do not view them as direct competitors. Google Search is most similar to Meta, not in the services offered, but in how they generate revenue. Advertising. And the third and fastest growing core of Google is the Google Cloud. This segment is a direct competitor of Amazon's AWS, and we'll get into that later in the video. So what actually sets Google apart from each of these? Do they have an economic moat? And is it durable? This is Google's first quarter 2024 results, and as you can see, it was astonishing. They generated $80.5 billion in revenues, an increase 15% year over year. Compare that to last year's increase of only 3% year over year. It gets even better for operating income, $25.4 billion in operating income, but most importantly, a 700 basis point increase in operating margin. Absolutely astonishing. And of course, that diluted EPS just keeps getting higher, $1.89 for Q1 2024. However, digging into those numbers and looking at each of the core businesses I was talking about, it's even more amazing. Google Search had revenues of $46.1 billion, an increase of 14.4% year over year. This is a part of the business many have expected to slow down quite a bit. And then YouTube, the advertising portion of YouTube, had $8.1 billion in revenue, a 20.8% increase year over year. And the other core segment of Google's business, Google Cloud, had a blowout of 28.4% year over year growth to $9.6 billion in revenue. Analysts were expecting around 25% growth, and they blew that out of the water. Even more astonishing than Google Cloud's revenue is their operating income. They had $900 million in operating income, an increase of 371% year over year. Google is finally demonstrating that their cloud business is profitable, and that profit is going up quarter by quarter. The massive expenditure Google has been making into their cloud business is finally showing returns. Google states as their mission that they want to organize the world's information and make it universally accessible. Their primary tool is search. After all, it's become a verb. to Google something. They also provide other apps such as Maps and Gmail. All of these are provided for free. So they monetize this information through advertising. They sell ad space to businesses large and small on their various platforms. They show ads along with relevant search results, the sponsor sites that you see at the top of a search, as well as ad space on sites and apps that partner with Google. This is their Google Network segment. This CNBC article, How Google's $150 billion advertising business works, breaks it all down. It's from 2021, but the mechanics are still the same. Google's main business is online advertising. Over 80% is from Google Ads. Google has been the market leader in online advertising for well over a decade and is expected to command nearly 29% of the digital ad spending globally in 2021. Number 2 is Facebook, and is expected to capture a little less than 24%. According to other sources, Google and Facebook are still number 1 and 2, but the share itself has changed a little bit. And ultimately, search is Google's most lucrative unit, making up 71% of Google's ad revenue and 57% of Alphabet's total revenue. So you can see that search, that is their core. That is what they're known for, and that is their core revenue driver. I linked the article below if you want to read through it just to see the mechanics of all of that, but I'm not going to really go into that for this video. Now, I want to assess how much of the market Google has and how protected this revenue is going forward. According to StatCounter, Google has 91.4% of the market for search across all platforms. They are unquestionably the dominant player in search. This provides an extremely wide economic moat. Therefore, they will command the majority of ad spend on search. According to Axios, Google had 28.8% of the market share for ad spend. This is down from 34.7% in 2017. So the question is, can Google continue its dominance? The biggest player diverting ad spend away from Google is actually Amazon, not Meta. Another site, eMarketer, shows Amazon at a 19% market share and Google at a 56.8% share as of 2021. It's hard to find data that is consistent with one another, but one thing is certain. Google had their highest single quarter for ad revenue ever in Q4 of 2023. To me, that suggests they are improving their market share despite some gloomy prognostications from bears earlier in the year. And speaking of Meta, Google and Meta provide different types of services. Google's advantage is in its search data, and Meta has an advantage with its social connectivity. Ads will be targeting different market segments in different ways, and many advertisers will spend on both. What we should be watching is their dominance in search in general. As long as Google maintains a 90% plus market share, Google will command dominant ad spend from advertisers. Right now, there is no viable alternative to search. As much fanfare as ChatGPT has, there is no real evidence that it has put a dent in Google. Anecdotally, ChatGPT seemed to have an initial curiosity, but after that, people reverted to their normal behavior. The reason for this, in my opinion, is that ChatGPT and Google serve different purposes. ChatGPT, it seems more useful as a tool to augment certain activities like writing or coding, for example, rather than getting a list of the local restaurants. If someone is getting a list of local restaurants from ChatGPT, they're already a tech-savvy early adopter type of user. For the masses, however, behavior seems completely unaltered. The only way Google loses its economic moat around search is if a competitor builds a demonstrably better platform, providing superior and faster results. Bing has been trying this for years, and they have even incorporated ChatGPT into it. They have yet to crack 4% market share. YouTube. You are watching this video right now on YouTube. YouTube is now the most watched streaming service in America. Streaming itself now has the largest share of viewership by category, and that viewership is growing. 32.8% in January 2023, 36% this past January. And both cable and broadcast have been shrinking. YouTube is also up year over year, and so is Netflix. YouTube has two primary options. It has content creators, what you're watching as we speak, and it has a streaming cable service, YouTube TV. I view YouTube as its own form of social media with no direct competitor. Netflix is the only other pure streamer, but the type of content is completely different. The competition is in the form of attention. What is a content creator doing to earn attention away from the latest Netflix series? However, I believe there is room in the market for both, precisely because they offer completely differentiated content types. Netflix, on the other hand, directly competes with HBO Max, Disney Plus, Prime, and so on. Netflix seems to be winning handedly, by the way. But right now, YouTube is the most watched streaming service and growing. YouTube Premium, the ad-free subscription service, had roughly 27.9 million users as of 2024. And you can see that number has been growing steadily since 2020. There's also YouTube TV. Now that does compete directly with Hulu and others like Sling and cable and satellite. This is also a battle that YouTube is winning. The service now has 8 million plus subscribers, more than Dish and right there with DirecTV. Right now, Charter is the largest cable service with 14.1 million subscribers. You can bet YouTube TV has their sights squarely set on the cable giant. Cable is dying, as you can see by this chart here. Streaming is ascending, and there is a lot of market share left to grab. YouTube TV also has the most bang for your buck at 94 cents per channel in its base package. Hulu is $1.04, DirecTV is $1.40. Philo comes in at 63 cents per channel, but only offers 42 channels, none of which are broadcast channels or live sports channels, the most watched channels. The reason, in my opinion, that YouTube TV is winning is due to live sports. YouTube TV ripped away the most valuable sports package on the planet from DirecTV last year, NFL Sunday Ticket. It's estimated that added over 1 million subscribers alone. YouTube TV also offers multi-view, watching 4 live games at once, which was a massive hit. They are also in negotiations with the NBA to bring some NBA games exclusively to YouTube TV. This follows a trend of the other tech giants going all in on live sports. This is interesting because ESPN, Fox, and Warner Bros. Discovery have teamed up to create a skinny bundle just for live sports. Live sports is the only real moneymaker left for legacy television. The other threat to YouTube TV is that many people only have YouTube TV for their live sports option. That's me included. So this will come down to 2 things: price point and offerings. If the price point for this service, rumored to be about $40 to $50, and it offers everything that YouTube TV offers, this could be a real point of contention for YouTube TV. So far, YouTube TV does have a couple things in their favor. The first is NFL Sunday Ticket. That is exclusive to YouTube TV. And if it starts taking content from ESPN, such as the NBA, that is another reason for fans to keep YouTube TV. The key here is YouTube TV has to secure exclusive offerings. Another factor here is that ESPN and Fox are still legacy broadcasters with all those finance issues that go along with it. Losing rights to different streaming services will only hurt these legacy broadcasters, no matter what the price point is. Not only that, I also see this as a defensive move. Defensive moves in business do not seem to last long. YouTube, and by extension Google and Amazon and Apple, have one thing that these legacy broadcasters don't have: vastly deep pockets. They have the cash to spend on sports properties. The NBA, for example, they're going to take the money, not the nostalgia. The third core business is Google Cloud Platform. Now, this is a direct competitor to Amazon's AWS and Microsoft's Azure. Both of those are far ahead of Google Cloud as well. GCP is a clear number 3. However, GCP just became profitable, and that profitability is growing. Their trailing 12 operating margin is almost 7%, still far behind Amazon AWS's operating margin of nearly 28%. But one thing that's nice about the cloud business is it does not require high marginal costs to secure new business, thus revenue. There is vast upfront expenditure to build out the infrastructure and the platforms, but after that, there is little ongoing maintenance expenditure. Each additional customer will be more profitable than the last. In other words, Google Cloud Platform offers high operating leverage. And this is a very lucrative space. This is why Google is going all in on Google Cloud. AWS is valued at over $1 trillion, and it makes up over 80% of Amazon's $1.8 trillion market cap. This is at least by my calculations. Online retail, however, is not nearly as profitable as AWS, as we'll see in a second. GCP is Google's fastest growing segment. It had revenue of $5.8 billion at the end of 2018, and at the end of 2023 had revenue of over $33 billion. That's an incredible 41.5% 5-year compound annual growth rate. I view the cloud industry in general the way I view most industries. Right now, it's a young industry with a handful of players. AWS and Microsoft Azure are the clear number 1 and number 2 at 31% and 24% respectively. But Google is third right now and growing quickly. And like any industry, as it matures, only a small number of players will come to dominate the whole space. I see Google as that third dominant player. Google does not have to be number 1 in cloud to have an extremely profitable business for investors. GCP generates revenue in two primary ways. First, it offers a subscription to the platform, basic access to platform services such as compute and app engines, as well as data storage and analytics, will run about $52 per month. As organizations move up the scale, Google charges based on consumption. Moving to a larger tier service, these organizations will pay over $5.32 per hour. Customer acquisition costs will continue to decrease since a bulk of the cost is overhead, not variable. The Google 2023 annual report regarding GCP operating income stated the increase in operating income was primarily driven by an increase in revenues, partially offset by an increase in compensation expenses, largely driven by headcount growth. This essentially means as revenue increases, costs do not. AWS trailing 12 operating margin is 27%, and Microsoft's Intelligent Cloud segment is 47%. However, Microsoft includes other items besides just Azure. Google Cloud, on the other hand, only has an operating margin of 7%. It is comparatively small. However, Google has been making large expenditures for years to build out the infrastructure. That investment is now starting to pay off. As more and more customers sign on or switch to GCP, those margins will grow. In fact, the organization I currently work for uses GCP. Once Google reaches scale, this is a highly profitable business and will generate even more cash flow for Google and investors. So that is Google's three core businesses: search, YouTube, and the cloud. The largest economic moats, they're in the search and in YouTube. Search is through sheer market dominance, and YouTube's moat comes from what type of streaming it is. YouTube is driven by a large network effect of creators. Unlike Netflix, Google does not have to spend vast sums of money on licensing and creating content. Me and other creators like me are basically doing it for them. This makes YouTube fundamentally more profitable than Netflix. GCP, it does not have an economic moat yet, but that will come when it scales. I believe that they need to secure themselves as one of the top 3 players in the cloud space. We'll see what comes of AI. I think right now it's way too early to tell who the clear winner there is. So how do we put a value on Google? Alphabet is a parent company to 3 fundamentally different businesses with fundamentally different economics. I view search most similar to Meta and that they both compete for ad revenue. And while YouTube does generate most of its revenue from advertising, it does have a strong subscription service and it's starting to branch into live TV. I view it most similar to Netflix. It competes with Netflix not on content offerings, but on attention. It seeks to provide entertainment and it wants your time and attention by providing something of entertainment value built by amateur creators. And GCP is most similar to AWS. So the first way I looked at Google is I looked at each of these segments as their own separate business and compared them to their counterpart. So let's take a look at these results and see if Google is fairly valued, overvalued, or undervalued in each of these core segments. And from there, I'll put it all together in my main valuation file and show you what I believe their true intrinsic value is per share. Let's start with a comparison between Meta and Google Ads. Meta's current price is around $430.17, about a market cap of just over $1 trillion. Google Ads, I estimate them at a price of about $125.47 and a market cap at $1.6 trillion. The way I derived that is I essentially looked at their trailing 12 operations, so their trailing 12 revenue, trailing 12 operating income, and then I had to actually estimate their operating margin because Google doesn't explicitly break it out for Google Ads. I use 40% as my estimate for operating margin because that's essentially what Facebook's was. The rest of the estimates, such as income tax and net income, they're all allocated based on each segment's percentage of market cap. The tax percent I use is the actual trailing 12 tax rate for Google. That brings us down to NOPAT, or net operating profit after tax. This is basically operating income multiplied by 1 minus the tax rate. This is what I'm using to get to our price earnings ratio. This is the price earnings ratio based on the trailing 12 numbers that I have here. 21.8, which is currently less than Meta's at 24.9. The price sales ratio for each of these, 7.5 for Google Ads, 7.7 for Meta. So based on that here, we can assess that Google Ads is actually cheaper from a strictly advertising business model than Facebook is at 21.8 versus 24.9. So we can ask ourselves, is this a reasonable valuation in comparison to Meta? If I look at this PE down here at 25.5, which is just over Meta's current PE of 24.9, what would Google Ads market cap be? That would give us a market cap of $1.8 trillion and a target price just for the Google Ads portion of the business at $150.52. We have to ask ourselves, is that a reasonable estimate? The price to sales is at 8.8, just over the 7.7 for Meta. I do believe this is a tad high for Google Ads though. And one of the reasons for this is Google Ads is just projected to grow more slowly than Meta is. So if we're talking about margin expansion over the next few years for Google Ads, it might be more realistic to use about a 23 PE. That brings the market cap down to $1.6 trillion and $135.76 target price just for the Google Ads segment of the business. Next, we're looking at Amazon versus Google Cloud. And I found this one to be one of the more interesting comparisons. So the first column here is just Amazon as a whole, their entire business. Then this is Amazon Web Services. And then this is the rest of Amazon in this column second from the right. And then the last column here is, of course, Google Cloud. The first thing I found very interesting was that Amazon's market cap is at $1.8 trillion so far. Amazon Web Services, based on my estimates here, is at a $1.5 trillion market cap. Nearly 80% of Amazon's business is derived from AWS. That puts AWS at a 77.5 PE. Amazon itself right now has a 62.4 PE. The PE for the rest of Amazon is at 32. Now, what is that PE actually based on? What is the rest of Amazon's business? They're an online retailer, they're a distributor, and they have a very small subscription business in Prime. But however, Prime Video is actually a net loser right now. So the comparisons I'm using for Amazon, the non-AWS portion, are these: PDD Holdings, Etsy, Mercado Libre, Walmart, UPS, FedEx, and Target. 5 retailers and then 2 logistics companies. And look at their PEs. Outside of Mercado Libre, these are not high PE businesses. In fact, their average is at 28.96, and that's including the 72.2 PE for Mercado Libre. So I chose a 32 PE for Amazon because I think there is a lot more growth potential in Amazon's non-AWS business, but it's not too much of an expansion over the average PE of what could be considered Amazon's closest competitors in this space. And when you really dig into the numbers, it actually makes a lot of sense. The operating margin for the rest of Amazon is at 2.5% compared to that 27% for AWS. That's a true retail business right there. So to me, it makes sense that AWS is a bulk of Amazon's valuation. But how does that compare to the Google Cloud? Well, like I said earlier, the cloud business has a 6.8% operating margin. And right now its net margin is at just under 6%. So based on these trailing 12 numbers right now, getting down to that NOPAT of $2 billion for Google Cloud, that would put Google Cloud's PE at a 56.3, well under AWS's PE of 77.5. The price to sales is even cheaper at 3.3. That means Google Cloud's business right now is just under $120 billion. It's still a very small business. And even if we expand Google Cloud's PE based on their growth rates, when they are expected to grow at over 20-25% over the next few years, putting their PE at about 62 only expands their market cap to about $130 billion. So we need to see some real growth out of Google Cloud for it to be considered a major player in the cloud space. But what if we put Google Cloud's PE to where Amazon is right now? Even then, that still gives us a market cap of $161 billion. Google has a long way to go to prove that this is going to be a very large business for Google. And I think once we see these margins expanding up to the margins where AWS currently is, that's when we're going to see the real valuation of Google Cloud show itself. And finally, the comparison between Netflix and YouTube. The first thing that really stood out to me is that their revenue on a trailing 12 basis is virtually identical. In fact, this is actually YouTube's ad-only revenue. This does not count the subscriptions that they're getting from YouTube TV, YouTube Premium, and YouTube Music. Google doesn't break out those portions of the YouTube business, but if you add those in based on the estimates that we've seen out for subscribers, it's fair to say that they're doing about as much revenue as Netflix is. But look at this here, a 22.5% operating margin for Netflix versus a 32% operating margin for YouTube. I am estimating YouTube's operating margin, but this is based on some other valuations I've seen online for YouTube. Those are linked below in the description. The biggest thing to note is YouTube is quite a bit more profitable than Netflix at this point. And that's due to the fact that YouTube does not have to license the amount of content that Netflix does. So using these numbers as a basis, I get to a market cap valuation for YouTube at about 260 billion, which is actually a higher market cap than Netflix is currently. And that's at a 28.5 PE versus Netflix's 38.8 PE. By comparison, YouTube is dirt cheap. Even if we bump YouTube's PE up to about a 33 for margin expansion based on some of the things they have coming down the line in the future, a 33 PE gives us just under a $300 billion market cap. In my opinion, YouTube is probably even more valuable than this. However, putting it at Netflix's PE, a 350 billion market cap seems a little bit high at this point, but it's still possible. But for now, we'll leave it at a 33 PE. I think YouTube's going to have to show some more of those 15 to 20% year-over-year growth numbers. Let's put Google's valuation all together based on the sum of its parts. Right now, Google has a market cap of just over $2 trillion, but that would put Google's PE at 25.5. For trailing 12 revenue, 318 billion, and at a 29% operating margin. All very healthy numbers right now. There's two other parts of Google's business I didn't mention: Google Devices and Google Other. I didn't really include Google Devices because it is a very small business and I don't really see it as much of a growth business at all. To me, it's most akin to a subpar Apple and a Sony electronic device maker. Not a lot of large growth ahead for it. Google Other is where they're basically making very large bets that may or may not pay off. One notable bet right now is the Waymo, the driverless taxi. If it hits, they'll move it out into its own segment, but right now it operates at a massive loss. But in summing the three parts of Google services, that would give Google services just under the $2 trillion market cap. So you can see Google services, primarily Google Ads, is what's driving Google's business right now. Like I said at the beginning, this is the core. Google Ads is what Google was built on. There's a lot of potential in the future for YouTube and for cloud, but they really have to start showing themselves in cloud, showing real profitability, real 25% plus growth year-over-year quarters to really start getting a better valuation than what they're getting now. That said, you can see how each of the PEs together really form that 25 and a 0.5 PE. And so based on these PE estimates that I made earlier, that would actually put Google's target price right now at about just under $180. So for me, the best way to understand Alphabet is to understand the specific segments that make up Alphabet and what they actually compare to out in the market. Next, let me show you what my free cash flow valuation for Google is telling us. This is the revenue model I have for Google over the next 10 years. You can see I'm projecting Google search at about a 9% compound annual growth rate over the next 10 years, YouTube at an 8.5%, and Google advertising as a whole at 8.8% over the next 10 years. And then Google Cloud, I'm projecting at a 12.8% growth rate for the next 10 years. All of these are based on analyst estimates, as well as what Google themselves have been saying. And then adding in my estimates for operating margin, net margin, and free cash flow margin over the next 10 years, you can see this is what I'm ultimately getting to for a valuation for Google. I'm estimating operating margin to expand to about 33% and ultimately free cash flow to get to about a 26.25% margin. You can see free cash flow growth over the next 10 years is 11%, which is well under what they're currently doing historically. And one of the more notable aspects of Google's earnings was they declared their first ever dividend. That dividend will be 80 cents for the year. Now, this is pure speculation on my part, but I think a 15% growth rate over the next few years is very reasonable. They'll have a very low free cash flow payout ratio at an 80 cents dividend. So it's reasonable to expect in the first few years of their dividend, they're going to grow it aggressively. It's very possible Google could become a dividend aristocrat in 25 years. And at a 7.5% dividend perpetual growth rate, that gives us a dividend discount price of $193.79. And for the peer comparison, I'm going to look at Meta Platforms, Microsoft, Netflix, Apple, and Amazon. That would give us an exit multiple price of $236.02 based on the median PE of 36.2. And finally, putting all of this together, we have a discounted cash flow price of $218.17, the dividend discount at $193.79, the exit multiple at $236.02, and a valuation average of $216.54. even with the jump up in price after the earnings last week, that is still a 33% upside. That share price did fall down a little bit this week, along with the broader market pullback. However, I think at a 10% margin of safety, we have an acceptable buy price of $194.89. At a 20% margin of safety, that gives us an acceptable buy price of $173.23. So even with that pullback, that brings us below our 20% margin of safety. And right now with the 25 PE, that forward PE ratio is at 24.8. It's tucked nicely between their 5 and 10-year average. I think there's a lot of growth ahead for Google. In fact, I'm quite bullish on Google. And now with the latest dividend, they're going to start returning a lot of that excess cash that you're generating back to investors. Google's margins are only going to improve. The CEO himself mentioned that on the earnings call. And with Google Cloud expanding, that's going to add real margin growth to Google. So I absolutely believe that Google, or Alphabet if you prefer, is very much a long-term play right now and should provide excellent returns for investors for years to come. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.